Welcome to this webinar on transition finance in the debt capital market. My name is Nicholas Valf. I'm the Deputy CEO of ICMA and also the Head of Sustainable Finance. I'm very pleased to introduce this webinar on a highly topical subject. Before we get into the substance, just a few words on the logistics. So this webinar is planned for approximately an hour and a half. We will make time at the end of the panel for some Q&A. I'm going to ask you to use the chat box and the Q&A box at the bottom of your screen to ask questions. You won't be able to intervene live, but I will do my best to pick out your questions and put them to the panel at the end. We're going to start with an introduction from our CEO, Brian Pascoe. We're then going to have a presentation on ICMA's recent thought leadership paper, which has the same name as this webinar, Transition Finance in the Debt Capital Market, and then we'll come to the panel. With that, it's my great pleasure to introduce Brian Pascoe.
Thanks, Nick, and I hope I'm live for everyone, and welcome. So good morning and good afternoon to everyone. As Nick mentioned, I'm Brian Pascoe, the CEO of ICMA, and I'm delighted to welcome you to this webinar on transition finance in the bond and wider debt capital market. It's great to see also such a high level of interest in this extremely important topic. I think we've had over 800 registrations, and this promises to be an intensive 90 minutes of information sharing and discussion. The debate on transition finance remains certainly at times contentious, but getting it right to ensure market-led and official frameworks are structured to have integrity and ambition, and at the same time are scalable and can serve the needs of emerging as well as developed economies, which have much urgent structural need to change to align with the Paris climate goals. It's certainly a critical initiative. On this point, we also have been very much encouraged by the recent initiation of Japan's Green Transition Plan and the first transactions from their Green Transition Bond Program, the first such sovereign undertaking of its kind, and with great potential to set the standard for other jurisdictions to follow. We will be updating you in the course of the session on ICMA's contribution to the debate overall, and we have brought together distinguished panelists from the OECD, GFANZ, CBI, the TPT Task Force, and Japan's METI. And time allowing, there should be an opportunity for Q&A after the panel discussion. ICMA has been at the forefront of transition finance since the publication in 2020 of the Climate Transition Finance Handbook, developed by the Executive Committee of the Principles, as well as by underlining the importance of integrating transition considerations in taxonomies through its publications and responses to consultations. Similarly, the release of guidance for sustainably linked bonds with the Sustainably Linked Bond Principles, also in 2020, was conducted with the intention of facilitating the development of a product that could be especially relevant and to serve transition finance. And as illustrated notably also during the recent COP28 discussions, the debate on transition is now at the center of both policy and market considerations, with notably calls for greater market-led financing. In parallel, and also importantly, progress has been made on official guidance on transition, as well as on standards for corporate sustainability reporting. In this context, we have now published a thought leadership paper, Transition Finance in the Debt Capital Market. In this publication, our focus is on how capital markets, and more specifically sustainable bonds, are financing the transition and what can be done to further scale their contribution to leveraging both market and official guidance. We confirm especially that the greatest challenge is the financing of the hard-to-abate sectors, where market participants need as much direction as possible on technologies and industry trajectories, while avoiding the risk of carbon lock-in and more generally controversy and greenwashing concerns. The paper reviews the latest guidance and recommendations on transition finance from both the market and the official sector perspectives. It also underlines the progress of international taxonomies in integrating transition and the latest developments on sectoral pathways and industry roadmaps, as well as the relevance of the new sustainability corporate reporting standards represented by ISSB and the ESRS. Building on that, you will hear that we propose the voluntary adoption of transition plans by the market in anticipation of regulation and make concrete proposals on what can be achieved. My colleague, Oscar Alton, will now give you more details on our paper before we move to the panel that will be moderated by Nicholas Pfaff, who I think will be very well known to most of you as head of our sustainability efforts and also introduced himself earlier on. I hope you have a very enjoyable and productive session. And with that, I'll hand over to Oscar.
Thank you very much, Brian. So let me share my screen and go to the presentation. Okay, I'm assuming everybody can see that. So I would also like to thank you for joining this event today. My name is Özgür Altun. I'm an Associate Director in the Sustainable Finance team of ICMA, and also one of the authors of the recent publication. So very quickly, Brian has already given you a very high-level outline of the paper, but let me just repeat it. It's just we in this paper that has come out on 14th of February, we have looked at the different transition finance definitions. We have tried to understand how sustainable bonds contribute to transition, and then highlighted the relevance of official sector and market-based guidance and tools like taxonomies and roadmaps, and then also pointed to transition plans as a real opportunity. And I'll come back to all of these points shortly. But before that, just as a reminder of the existing guidance from the principles, the principles published the Climate Transition Finance Handbook in 2020. So it was really ahead of all the transition developments, and recently the Transition Finance Handbook has been updated. So in essence, the spirit of the CTFH is the following. If you're especially from a carbon intensive industry and business, and then you would like to issue a transition themed bond, the best practice we say is that to have a broader entity level, forward looking and science-based strategy that goes beyond the issuance of the bond. It can be seen kind of a broader commitment to transition that goes beyond the instrument itself, and we say that this is actually the best practice in order to give confidence for transition themed issuances for your investors. And very importantly, all these science-based ambition targets and strategies should be backed up with a clear implementation plan. And even like going with more detail, if you need to disclose what capex and opex you're going to set apart for the implementation of this plan. So it's actually very concrete. It's not just the strategic thought piece that principals have put out there since 3 years. In June 2023, it was updated, but it was more for usability reasons. Its fundamentals haven't changed. Some details have been added on scope 3 emissions, for example, or disclosure of locked-in emissions, but the fundamentals really remain same. And then obviously we have not been the only one who provide guidance on transition. As you can see from the bullet point here, there have been several very influential organizations who provided transition related guidance, and I'm happy to say that many of them will be with you in the panel shortly. So coming back to our recent paper, before any deep dive, we obviously looked at what transition finance means, and for that we also looked at what other influential organizations said about the transition finance, how they define the concept, and we actually included an appendix, a specific dedicated appendix, which include on a non-exhaustive basis the transition finance definitions from other organizations. So looking at those precedents plus our own thinking, we came up with 3 overlapping definitions for transition finance. It's going from a very wide and broad definition, which is this economy-wide transition that refers to kind of all kind of sustainability objectives and goals, including the social one and biodiversity, and like, for example, 6 objectives of the taxonomy. And then in the middle, we have the climate transition. This is more about the goals of the Paris Agreement, net zero, but it can also be financing renewables, for example, or buildings or things like that. So green, it includes already green sectors. And then as the narrow scope, we have the hard-to-abate transition. And this is where things are a bit more challenging, because it's about fossil fuel and hard-to-abate sectors, decarbonization. So then the second thing we did is to look at how the sustainable bonds have been contributing to the transition. This is now a market of $4 trillion US dollar. And how it contributes to transition depends very much on which transition you're talking about, as per the very previous slide that I just explained. So if it's about climate transition, i.e. the financing of renewables, like green buildings, sustainable transport, use of proceeds. Our estimates show that 90% of use of proceeds in the green use of proceeds market are related to that. And SLBs as well, like almost 70% of SLB KPIs are greenhouse gas reductions or renewable energy installation increases, for example. But if you're talking about hard-to-abate transitions, as you can see from these 2 charts at the bottom, this has been much more difficult. So we have seen that these industries have been largely absent from the sustainable bond markets. Their issuance represents 3.6% of the overall total, and the specifically labeled climate transition labeled bonds is 0.4% of the overall market. So it's quite minimal numbers, as you can see, and we attribute this partly to the fact that there has been a lack historically there has been a lack of consensus on acceptable technologies, trajectories, as well as hesitation because of greenwashing fears and concerns, for example. Well, going through this narrative, the point we are making in the paper is that now we have very good tools that exist in the market that comes from both market-based sources and official sources that can actually alter this situation and alleviate these concerns of fossil fuel and hard-to-abate sectors if they want to join this market and wider sustainable finance space. The first one is taxonomies. So we are looking at taxonomies in detail in this paper. We have a dedicated annex that goes into detail and that looks at how different taxonomies reflects and incorporates transition. And then some examples of those is that there is recognition, for example, of this amber so-called interim transitions on the way to green. There are some criterion taxonomies that aim to avoid carbon lock-in. For example, sunset dates is a common one. And then more recently, some taxonomies have started to require some entity level targets or plans backing up an activity level transition. And also in the implementation, we know from EU taxonomy, for example, there's a lot of focus on CapEx and CapEx plans. So all of these things are actually like very, very transition relevant. And we have quite an extensive section analyzing those. Similarly, decarbonization pathways and roadmaps can really serve hard-to-abate sector issuers and fossil fuel sector issuers to come and join the sustainable bond market and wider spectrum of sustainable finance. Japan has been a leading source in providing sectoral decarbonization roadmaps, and we will hear from Mr. Kobayashi in shortly, so that you'll have more insights on that. And actually, like many influential sources highlight that there is a need for developing sectoral pathways that are adjusted for different regions in order to make it more realistic and in order to give issuers kind of a forward-looking guidance on what they should do, when they should do, in all in this way to net zero by their own jurisdictions' ambitions. And then the IEA scenarios have been very influential around the world. So IEA scenarios and pathways are already being used as the benchmark to issuances, as like they're being referred in SLB targets as an ambition benchmark, and IEA scenarios are also the underlying basis of some certification, some significant certifications, such as for example the SPTI. Well, I will say, and Brian mentioned this point, and I would like to repeat it, is that one of our fundamental aims in this paper is really to promote the early adoption of transition plans. We believe transition plans represent a very big opportunity for unlocking transition finance generally. So what are transition plans? And this is not an official definition, but as a summary, these are entity-level forward-looking disclosures on decarbonization ambition, targets, resources, and so on and so forth. And they need to be strategic, so they cannot just be for marketing. And then they need to be supported by an effective climate governance. And currently, these transition plans are being developed as a sub-reporting concept of under the international corporate reporting standards like ISSP standards, IFRS S2, and also the European standards, the ACRS S1. So they are actually included in these standards. So that's why actually initially we expect them to be a disclosure obligation only, but not a behavioral obligation, and that goes along the lines of, so you need to disclose a transition plan if you have it. So it's not really forcing you to have a transition plan, but this may change in the near future, as we know that in the EU, for example, there is already active debate on making transition plans mandatory, so beyond a disclosure obligation. And then, even if this is not the case, what we can anticipate is that investors and banks may increasingly ask and assess issuer transition plans just because they are themselves committing to reduce their financed emissions. So even it can be mandatory. If not, it can become into a de facto requirement because of investor pressure and demand. And then we are also making a point to regulators that they can think about creating further market dynamics through buy-side regulation. For example, in our response to SFDR consultation in the EU, we said that all funds, it could be considered to impose a disclosure requirement on all funds, i.e. even the funds that do not have any sustainability claim, to disclose for the asset owners to what extent the fund is exposed to entities for implementing climate transition, credible transition plans. And here the intention is obviously through a simple disclosure to create kind of a race to top between the asset managers because of the asset owner demand. So that's one of the proposals we have made. And then, as with the Climate Transition Finance Handbook, obviously, transition plan frameworks that we see are very close to Climate Transition Finance Handbook. They're really about the same topic. They have the same spirit and entity level forward-looking nature, so on and so forth. So we believe that adopting a credible transition plan will also support your climate transition themed issuance. So it's the very same logic. Having said all of this, we highlight very much though that there is need for international consistency, because having looked at the ISSB, the ESRS, UK TPT, and our Climate Transition Finance Handbook, we see that there is currently variation in the level of specificity, structure, detail, the level of prescription, and so on and so forth. So that we need to harmonize those. We need to have more international standardization for transition plans to be a successful tool for the market. And UK TPT, you will hear from UK TPT, and they have the most advanced, arguably the most advanced climate transition plan framework so far. So, in order to support the efforts of early adoption, as well as contribute to the debate around international standardization. We came up with this table in Appendix A of the paper, and here the message is the following. This is not an exhaustive list of requirements, and it doesn't solve all the inherent difficulties, for example, for adopting science-based ambitious targets or disclosing Scope 3, so it doesn't really solve the inherent difficulty of those, but we came up, looking at these 4 different disclosure frameworks, we came up with this table that really gives you these 15 actions and disclosures. And then if you focus on those and align with those, we believe you will have made a big step forward in terms of aligning with the 4 of these frameworks in one go. So that was our intention. And also we proposed these elements, these bullet points under a 4-pillar structure to help with the international standardization effort. Just to let me also underline here is that this is an ICMA staff effort. It's not really, it's been not been like a official market guidance, but we try to contribute to the debate by really looking at what could be the intersecting point of these frameworks. If I'm a multinational, for example, and I want to have one single transition plan and align with all these 4 frameworks in one go, and that's why it's going to be beneficial to me. That is what we think you need to focus on, without being exclusive. And we have another appendix, which is Appendix B. Then there we compare in detail these 4 frameworks, item by item, and then you can look at it and to understand how we came up actually this Appendix A table. And let me finish here with the conclusions. So basically, it's a bit of repetition, but what we said is that the climate transition is currently being helped with sustainable bonds, because sustainable bonds is about renewables, green buildings, and sustainable transport, etc. But what we observe is that the hard-to-abate industries and fossil fuel industries, they have been largely absent from this market. And then we think that that's because of their fears, that because of reputational concerns or lack of consensus on acceptable technologies or trajectories. But we are saying that now you have good tools to look at if you want to overcome these concerns and join the market as credibly as possible. And then last point, we say that transition plans are really a good opportunity. They are very important. Let's not wait for the regulation to come or for investor pressure to really worry us. So let's be ahead of the curve with transition plans, also seeing those as an opportunity for our own entities and organizations. So with that, I'll finish here and I'll hand over to my colleague Nicholas for the panel discussion. Thank you very much.
Oscar, thank you very much for that presentation and particularly the conclusion in terms of our contribution with this outline for an integrated transition plan. We're now going to move to the panel, and I think we've got a really great lineup for the panel. I'm going to ask them to come on camera now, and I will introduce them before jumping to the first question. So on our panel we have Alice Carr, who is a executive director for public policy and just energy partnerships from GFANZ. We have the indomitable Sean Kidney, CEO of CBI, Climate Bond Initiative. We're very pleased to have Izuru Kobayashi, who's the Deputy Director General for Environmental Affairs at Japan's MITI. We have Kate Levick, who is an Associate Director, Sustainable Finance at E3G, but very importantly for this panel, she's the co-head of the UK Transition Plan Task Force. And we have Robert Youngman, who is the team leader at Green Finance and Investment at the OECD. Now, I'm going to start with you, Robert. I think many of us have noticed that the OECD has published extensively on transition finance over the last 2 years. Many of us have contributed, commented on your work. We referenced it in our paper extensively. So I just want to ask you, what are the main challenges that the OECD has identified and for transition finance, and what are your key recommendations?
Thanks very much, Nicholas. It's really a pleasure to be here with you and the fellow panelists to see everybody here on screen. And I'd like to thank ICMA also for our cooperation to date, including on a survey that we did a while back. So starting with our stock take of transition finance approaches back in 2021, we found that existing differences among transition finance approaches, including with respect to their degree of environmental ambition, had the potential to fragment markets and potentially reduce investor confidence. So our take early on was that a greater focus on environmental integrity and transparency was needed. And so from that initial stock take, we developed the OECD OECD guidance on transition finance back in 2022, which included this aforementioned industry survey. And you're asking what the main challenges we found were, and based on the responses we received, 79% indicated that a lack of detailed information from corporates on their climate transition planning was the main obstacle preventing them from identifying companies to finance with helping with their net zero targets. Similarly, at a similar level, 76% said a lack of comparability in corporate disclosure of climate-related data and transition planning was a major obstacle. So as we thought about how to address these, in the guidance, we set out 10 elements of a credible transition plan. And our argument from early on is that whether you have a taxonomy or broad guidance or high-level framework, a credible transition plan is at the core of being able to finance credibly in this area. And I would say that in addition to the centrality of transition plans, it's important to note that these plans should be in line with the temperature goal of the Paris Agreement, and that there should be sort of transparency there on your understanding of how you do that. So I won't go through all the elements, but maybe some of the key ones, including what we focused on in more recent work. Targets should be long-term, but include interim targets that are consistent with the 1.5 degree reference scenario, explaining underlying assumptions, which is tricky. And I think maybe we'll get into that topic, but the more transparency you can provide here, the better, so that investors know exactly what they're getting. And there's differences among countries, but there's no reason not to be transparent about it. That will help market development in our view. Secondly, that targets are based on available sectoral pathways, technology roadmaps, and taxonomies, and we're going to talk a lot about that. And I know, and I'm looking forward to hearing Sean talk about work with Japan and hear from Mehdi too about their very important work that's happening in this area. I will be the scolding reminder of some of the challenges, maybe beating Sean to the punch, about the challenges about meeting net zero by 2050. So according to the IEA and IPCC, to reach net zero by 2050, no additional fossil fuel exploration. Existing and planned fossil fuel infrastructure without additional abatement currently exceeds 1.5 degrees. Continuing to install unabated fossil fuel infrastructure will lead to emissions lock-in. And then consequently, transition plans that rely on investments in fossil fuel exploration, sale, or distribution are likely not compatible with the Paris Agreement temperature goal and lead to lock-in. And this is sort of the challenge and paradox in transition finance, that we need to encourage sectors to move. There's a desperate need to do that. And at the same time, there is a real risk and a need to tackle to the best degree that we can this risk of lock-in. And carbon lock-in risk can arise when transition finance flows to assets or technologies that present a marginal improvement. An example can include efficiency improvements of industrial plants that currently mainly rely on fossil fuels such as blast furnaces to generate heat required for heavy industry production and processes. So I see I'm trying to keep track of time, Nicholas, and so I will leave it here, but just to say that in our report on mechanisms to prevent carbon lock-in in transition finance, there's a number of measures to help convince investors that the corporate is serious about implementing its plans to get to Paris-aligned technologies. And there's a lot more work that needs to be done and best practices in this space. And I look forward to continuing to talk with all of you in this session and afterwards about addressing the paradoxes and seeing how we can move forward. Thanks very much.
Robert, thank you very much, and thank you for reminding us that when we talk about transition, we're always walking a really fine line. I'm just going to do a quick reminder from a logistical point of view. Some of you have already started to ask questions on the Q&A function. That's exactly the right thing to do. We're going to try to keep 10-15 minutes at the end to answer those. So keep them coming, and please use the Q&A button. I'm now going to move to Alice Carr from GFANZ. Alice, GFANZ has done a great deal of groundbreaking work for transition plans focused on financial institutions. And I wanted to ask you how that's going to flow through to the corporate sector, particularly this hard-to-abate sector. And do you think banks are going to start requiring from these companies to have transition plans?
Thanks so much, and thanks for having me today to discuss these important topics. For us, making progress on transition finance and transition plans is sort of central to what we're here to do. And just to remind, so GFANZ brings together more than 675 financial institutions globally that have made net zero commitments, and they're across all sectors of the financial system. So banks, but also asset managers, owners, everyone through to data providers and infrastructure. And so having made their commitments, all of those firms individually are then working to set targets for their activities and to develop their own transition planning. And through our work over the last few years, we've developed both definitions of transition finance that the financial sector can deploy, but also a framework for transition planning. And so I just wanted to say a quick word on the transition finance definitions, because we agree with all of you that this is critical. We're not going to get to net zero by just growing the green part of the economy. Of course, that's important to do, but we have a very short time frame and we need to transition high emitting sectors. And so in our own work, we have 4 transition finance strategies that we think need to be scaled. The first one addresses climate solutions. They're the things that are typically covered by existing taxonomies. We also, though, ask firms, financial firms, to consider whether the clients they're financing have got a transition plan themselves, and whether they're already aligned with an appropriate pathway to net zero, or they're converging on a pathway to net zero, and to scale financing both to aligned companies, but also to aligning companies who may need that finance to transition. And then finally, we do want finance to problem solve for the most tricky issues that we face in transition. And so we also have a transition finance strategy that's around financing the managed phase out of high emitting assets that don't have a future in the transition. And so we're exploring some coal phase out transactions there. Now, what do we want the firms to do with all of this? So they should develop their own transition plans. We have a framework that it was delivered by practitioners, delivered by CEOs in 2022. It has 10 elements across 5 core themes around governance, around setting the foundations and targets for your plan, implementation, engagement with your clients, with government, with stakeholders, and also a section on metrics and target setting. And what we are seeing is that firms are increasingly deploying the framework on a voluntary basis, and as mentioned already, it's largely voluntary to date. And as they do that, they are in turn asking their clients, just as you said, whether they have a transition plan, what pathways are they on. And so we would see these two things coming together, and that the financial system engages with corporates on their transition planning, on their plans for the future, makes an assessment about whether these firms need transition finance, and allocates it as such. And I think there's just a couple of things I wanted to quickly mention before handing back. We really do need to converge on globally consistent definitions of transition finance. If we all have different ones, that's going to be problematic. They will be different to the way we've approached taxonomies. So taxonomies tend to identify activities and decide whether they're green or not green, but transition is dynamic. So the way in which we're going to assess whether a company or a strategy is transition aligned is going to be fundamentally different. So we just need to recognize that and build out for that. We need transition planning. As mentioned, it's not generally required globally at this time, but we could do with a common global baseline for transition planning that allows global financial institutions and global corporates to allocate finance and attract the financing that they need, and make sure that emerging markets get the financing that they need also. And I think, importantly, having developed a voluntary framework, we're looking to engage with any countries or standard setters who are moving to implement mandatory requirements. And I know you're going to turn to Kate next, and it's been a key focus for us in the UK to work closely with the UK TPT as they build out a disclosure framework for transition planning, because that's something we haven't done ourselves. Thank you.
Thank you so much, Alice. That was really interesting, and also thanks for reminding us of the dynamics of voluntary approach versus mandatory regulated one. As you know, the sustainable bond market functions largely on a voluntary basis. That we've achieved, I think, great things there, but that may not be sufficient. And so making the transition, indeed, Kate Levick, who is the co-head of the Secretariat of the UK Transition Plan Task Force. The UK has been doing great work with the industry, putting together what is very granular guidance. We've referenced it. It is, it stands out there as a very comprehensive piece of work. It's now being reviewed and consulted on. What is your message? Your key message to issuers with this, and how easy would you anticipate that issuers, particularly from the hard-to-abate sectors, would be able to align with this standard, whether it remains voluntary or becomes mandatory?
Oh, thank you very much, Nicholas. It's a good question. And can I just say it's great to be following Robert and then Alice in terms of being able to then talk about the work of the TPT, because they've set the scene for that so beautifully. I will just briefly detour and say a little bit about the TPT for participants who might not be as familiar with just what it is. So the origins of the UK's Transition Plan Task Force were that it was announced at COP26 to set out what would be a gold standard climate transition plan disclosure. And that wasn't just an isolated action by the UK, it was in the context of the UK saying that, Rishi Sunak at the time, the Chancellor of the Exchequer, as he was then, was saying that the UK would be a net zero aligned financial centre, and that the UK would require listed companies and financial firms to disclose transition plans. And it was in that context that a task force was created to say, what does a gold standard transition plan disclosure look like? So that was now 2 years ago. We actually just passed the official 2-year anniversary of the TPT, which of course got off the ground a couple of months later. And so we're very close to fulfilling the mandate that the government set us at that time, which was to set out that best practice. We already published last October the disclosure framework, which is applicable to any sector. And then we are close to publishing some deep dive sectoral guidance which was also in our original mandate. We've already published a sector guidance summary, which looks across sort of 40 different sectors and talks about what would be particularly important elements to consider for a transition plan for those sectors. And then we're deep diving into 7 specifically, of which some are financial sector, some are real economy. But what is this task force? So the official task force, the one you'll find listed somewhere on the gov.uk website, is what we call our steering group, which is the governance of this work. And that's a mixture of different kinds of stakeholders. It's co-chaired by the UK, a minister from the Treasury, which has changed once or twice during the task force's lifetime and is right now Baroness Veer. And then also Amanda Blanc, the group CEO of Aviva. And then on the task force, we have the FCA, that's the financial regulator in the first instance would be carrying forward that UK regulation. We have a number of different firms involved, some of which are also involved in GFANZ transition planning work. We have WWF as a civil society representative. We have GFANZ themselves on that steering group, and also the ISSB as an observer and the Bank of England as an observer. So bringing together a number of different kinds of stakeholders to supervise the creation of that best practice framework. And then sort of sitting below that steering group, we have had a great number more organisations involved. There's a delivery group that has actually been more responsible for the drafting, which contains representatives of all those organisations. So again, GFANZ has participated in that, and the ISSB has attended, but also quite a lot of other organisations, many of which are involved in the formation of different transition planning and transition finance work, because we wanted to bring all that together and try and make sure that we had the maximum possible alignment and interoperability. And then that work has also involved the creation of various working groups and work streams to look at different topics or create different products. The OECD has observed some of that work as well. So we have done quite a lot of stakeholder engagement. We did a call for evidence early on. We've consulted on every product that has been put out, and the final sector deep dives have already been consulted on. That went out last November. When we get stakeholder input, what the stakeholders really, there's lots of things that we get from stakeholder input, but one of the very, very clear messages is that they want that interoperability and alignment, and they don't want something new. They want something that makes sense and helps them to do what's already being indicated to them. So that's very much what we have attempted to do. And the disclosure framework the TPT has put out, it draws on the GFANZ transition planning framework. It uses the same 5 elements that would be very recognizable to a firm that's already been using the GFANZ framework. Does develop them out in a bit more detail in terms of what firms should disclose. It's also building on the ISSB and is using all the same sort of language and concepts as ISSB. So a firm that is looking at the ISSB standards, where it says that you should disclose a transition plan, if you've got one, can immediately turn to the TPT to say, well, this is how you would in more detail disclose that transition plan. And we've done that very, very deliberately in order not to do any duplication. It's also worth mentioning that the TCFD, which is another thing we've worked closely to align with, has now been absorbed into the ISSB. But we've actually published mappings of the TPT framework against both TCFD and ISSB. So some key things that you'll see in a second, where I'm just briefly going over this in terms of what the shape of the TPT framework is. I promise not to go into massive detail on this, but it is shaped around the 3 A's. So ambition, action, and then accountability. Like, what is it you're trying to get to? What will you do? And then how will you make sure you do it? And then within that, there are the 5 elements, which are essentially the same 5 elements that we have in the GFANZ transition planning framework. And then overarching to this, which I think again is very compatible with approaches taken by GFANZ and others and relates through to the ICMA presentation we saw, we have this thing that we call the strategic and rounded approach. So this is saying that a transition plan should be about how a firm will meet its decarbonisation target, if that's what it's set, which will apply to many, many firms doing transition plans. But it should also be talking about the risks and opportunities from the climate transition and how it's going to manage them. And it should be talking about how it's going to contribute to the overall economic transition. And this, we feel, is quite important for a firm level plan, because we absolutely don't want a situation where a lot of fantastic firm level plans all exist and all involve selling off your assets to somebody else. So, we are looking at this ties in with, some of the work that's been done in the broader space. So, for example, the OECD's work on lock-in or the GFANZ work on phase-out. There needs to be a more holistic approach to all of this in terms of how a firm talks about what its real impacts are. And the TPTs recommended that firms report annually against their transition plan, but they would take a look at the whole thing and refresh it every 3 years. So I should emphasize, as the presentation said at the beginning, this is best practice guidance. So the FCA will consult later this year, the Financial Conduct Authority, on its regulation, and has already indicated its intention to consult on a regulation that builds on or draws on TPT. There was also a commitment last year in the UK's green finance strategy to look at whether that could be extended to all large companies, which would take the scope of a regulation sort of out of just what the FCA is able to cover. So that would require some legislation as well. So we're still awaiting that consultation. It's worth saying, though, that the UK is not an island. Okay, the UK maybe is a bit of an island, but in terms of firms operating in the UK, some of them are already going to be in scope for the EU's CSRD, for example. They're going to have to be publishing transition plans irrespective. So this is very much a trend that's coming through, and requirements are slowly but surely starting to come through on firms to do this. So you won't be surprised to know my message to issuers, finally getting to your question, is obviously to get started right away. In the TPT context, I would say, don't be terrified of it. Remember, TPT is a best practice framework. So when it does come through to regulation, initial regulatory requirements are not likely to demand immediately full TPT disclosure. They're more likely to make use of approaches such as phasing in more detailed disclosure, use of comply or explain, which is very common in the early stages of a disclosure requirement, use of proportionality, potentially for smaller firms. But it's really important to go back to the shape of what TPT has laid out and what is actually best practice. Having those elements, the 3 A's, the ambition, action, accountability, having in mind that strategic and rounded approach and looking across all those 5 elements is important. And a transition plan that only does a bit of that but then misses out other parts won't be a really fully rounded transition plan. So I would really encourage firms to get started as soon as possible, just thinking about that, thinking how they'd cover all those different elements. And it's absolutely not essential to get everything right or be able to do everything immediately, but thinking about the whole shape of what this is important. And I would also say the more firms start to get to grips with this now, the better fitted they will be to satisfy future requirements, but also to meet the needs of their stakeholders, which are already coming through, which have been talked about by others, the requests of investors and sometimes purchases in the supply chain as well. I think we're only going to see more interest in these plans.
Okay, thank you. That was fantastic. I sort of, out of all the great stuff you said, I sort of took away 2 things. One key message, which is worth, I think, repeating, which is transition is not about selling the bad stuff to somebody else. It's not about sort of passing the hot potato to somebody who's buying it because they think it's at a very steep discount. And the other one is don't wait for perfection. Get started with the transition plans, particularly because we're in an environment now where it's voluntary and you can experiment. Now, I really want to turn to Miti, to Kobayashi-san, because we're going to talk about putting all this in practice. Japan has adopted early on the recommendation of ICMA and of the principles with respect to disclosures. So the Climate Transition Finance Handbook, it's been integrated in official guidance. And that's been a while ago, it's almost 2 years ago. So there's been a long preparation and reflection. There's also been tremendous work around industry roadmaps in the hard-to-abate sectors. Again, it's been done with great thoroughness and consultation. And this is all culminated last month in Japan's first sovereign climate transition bond. So my first, question to you, Kobayashi-san, is how has all this great work paid off?
Well, firstly, thank you very much for having me in this very important panel. And yes, I think our work is starting to pay off. And well, let me explain a little bit about Japan's green transformation strategy. Japan is aiming for net zero by 2050. And the Japanese government basically estimates that at least 150 trillion yen or $1 trillion investments are needed over the next 10 years to just kickstart the transformation of Japan's economy and society to reach this very ambitious goal. And we call this process green transformation, or GX. And to mobilize these 150 trillion yen GX investments, the government is planning to implement support programs amounting 20 trillion yen, or 130 billion over 10 years. The purpose of the GX transition bond is to finance this 20 trillion yen government programs. The first 1.6 trillion yen climate transition bond was issued last month, as was mentioned. And this is the world first sovereign transition bond. The framework of the GX transition bond is basically based on the GX promotion strategy, basically approved by the Cabinet of Japan. So this GX promotion strategy is essentially Japan's transition plan. And we think it is an important achievement that the framework was evaluated by the third-party organization, which is JCR of Japan and also DNB of Norway. And they provided a very positive second-party opinion. CBI also kindly certified this first bond, and they kindly provided very positive evaluation as well. And overall, we believe that we have gained a very good understanding from the wide range of investors, and we observed a good amount of subscription requests and a certain level of premium as well. And when we conducted IR meetings with investors from Europe and the United States, we were quite surprised at the very strong interest indicated by them with Japan's GX policy and the GX bond. And actually, we are very much pleased and delighted with it. And we have often been asked why the Japanese government went for transition bonds rather than green bonds. Although the programs to be covered by the bonds are mostly R&D support for clean technologies and subsidies for the clean projects. It is because we wanted to stress the importance of transition finance. And in fact, the Japanese government has been working on transition finance as a first thinking. And believing that the transition finance needs to become the mainstream of climate finance alongside with the green finance. Naming the bond as a transition bond is actually one of our efforts to shed light on this very important issue. And one of the challenges for the business companies to obtain transition finance is to develop a credible transition plan. And to support this process, yes, the Japanese government issued a basic guideline for transition finance based on ICMA's Climate Transition Finance Handbook. And also, we developed technology roadmaps for 8 hard-to-abate sectors, including steel, chemicals, and automobiles, aligned with the goals of the Paris agreements. And we have also developed policy roadmaps for 22 sectors, such as batteries, steel, aviation, shipping, and lifestyle industries, to indicate policy directions in these sectors. And at the end of last year, we also formulated investment strategies where the government would provide investment support in each of the sectors. And these roadmaps can be deferred by the companies when they develop their own transition plans. And for example, when steel companies, for example, are making investment decisions on how to introduce hydrogen reduction steel making, obviously the technological readiness level of the technology and also price of the clean hydrogen and whether the market for the green steels is available are three major factors they must consider. And these roadmaps actually provide such key information and assist the process of formulating their transition plans and making investment decisions by reducing policy uncertainty. And as a framework of the green transformation transition bond received favorable SPOs, those roadmaps would receive higher level of credibility. That's what we expect. And the government also have been providing financial support for model projects for the transition finance. And so far, we supported 27 cases in total. And based on these efforts, we already observed over 1.6 trillion yen of the transition finance in total by the end of 2023. And we do hope that this amount will be increased significantly and contribute to the 150 trillion yen investments alongside with the green finance. Thank you.
Kobayashi-san, thank you very much for that, and congratulations again on where Japan is. I'm going to turn to Sean Kidney of the Climate Bond Initiative. CBI has been doing some great work around transition over the years, and has specifically been very involved in the situation in Japan, and as mentioned, has certified the latest bond. So Sean, I'm going to stop putting words in your mouth. I mean, how would you characterize the importance of what's happening in Japan?
Well, first, certification is a public standard, and the Japanese bond meets that public standard. It's not a matter of us deciding that it's fantastic or anything like that, just to be clear. There's a whole process of getting science groups defining criteria. But it is important to note that the bond that Japan issued did meet the certification criteria for climate bonds activity. Now, we don't actually differentiate between green and transition. We say it's a certified climate bond, just to be clear about that. But there are different kinds of certifications that are relevant to the market. You know, we need the transition. Oh, Alice said it quite earlier, and as everyone on the call has said it, and for all the listeners out there, isn't it incredible? This constellation of people all saying that transition is what we need. We've got to change the planet quite quickly. We need to change the planet quite quickly in line with those very tough IPCC requirements and the IEA pathways that have elaborated what that means, that Robert talked about. He's absolutely right about that. The Japanese GX plan got a lot of bad press last year, I'm going to say, because it focused on things that actually weren't in the bond. Now, this is something for everyone to understand. The bond is absolutely focused on investments that are, we think, critical and material to achieving a rapid transition. There's a hell of a lot of renewable energy in there, for example. There are subsidies for industries to improve the efficiency of the manufacturing. There's R&D around hydrogen and ammonia use and so on. And we need a lot of R&D. And this is one of the points to make for other governments considering this. Investments in research and development towards our 1.5 degree goals counts, needs to be scaled up, is really important. So, our view is that many governments now, the exciting thing of the past few years, especially since the Biden Climate Summit, has been the extent to which a number of governments are deciding to move. The US government with the IRA, the Inflation Reduction Act, which, by the way, has some crappy stuff in it. Let's be clear. That's the compromise you make to get it through Congress. But 80% is for clean energy of various sorts. It's brilliant. And we have to celebrate and support that commitment. And ditto in Europe with Invest EU and various other European programs, and ditto in China with the Green Transformation Program, which is particularly interesting because it's focused on supporting the industries of Japan, which is a strong manufacturing base, to make the change to become, not just to become low carbon, but also to seize the opportunities involved in the world going low carbon. And there's a word I would like to insert, Nicholas, in our discussion of transition plan, which is the word opportunity. We need to be thinking about TOPS in the future, transition opportunity plans. It's not about dealing with risk, that's part of it, but it's most importantly about taking advantages of the opportunities coming our way with this transition. The world economy is changing. I don't find an investor globally doesn't believe that the future has been decided. It will be green. The question is the speed of the change, which is, of course, material to addressing climate change, and who's going to be a winner and loser. All companies need to be bearing this in mind and realizing, the auto industry is changing, the energy industry changing, the steel industry. Now that we have the scent of green steel available, will change quite quickly as consumer demand, as governments drive change. How do we make sure our corporates, let alone our governments, can prosper in those changed economy is the thing that people need to understand about transition plans. It's not just about addressing the bad side, it's about addressing the good side. And that's what the Japanese GX plan, the Green Transformation Plan, is, a great example really about how supporting that. And, I met with a major Japanese corporate this afternoon. I'm in Tokyo at the moment, who were talking about the support they're getting out of the Green Transformation Program for their research and development. And it's an enormous suite of clean energy, green hydrogen products that they're bringing out to market now. And I'm looking at this, I'm thinking this is fantastic, including, by the way, the commercialization of stuff which was originally done for green hydrogen is now being used for direct air capture, like spin-off products. And I'm thinking, yes, that's what we want to see. So the research and development components are important. The opportunity components are important. And most importantly, the close working collaboration between METI and other ministries, between finance, represented by Japanese banks, and the investment community and corporates. That dance step between the three parties is what every country needs to see if we're going to change quickly. And speed, as Robert talked about, is of the essence right now.
Sean, thank you very much. I'm going to come back to Robert now. We've talked in our paper a lot about the development of, in addition to taxonomies, to industry pathways, roadmaps, focused especially on the hard-to-abate sectors. How significant is this additional advice, do you think? And is this something that all the key jurisdictions should be working on, and to some extent following Japan's lead and great example?
Thanks, Nicholas. I think Sean brought up something very interesting, a sort of dynamic between different actors, and particularly policymakers, and the development of sectoral pathways, and how that relates to corporates who are seeking certainty, but also seeking to project credibility in transition plans. And so that would seem to be essential when, as part of your transition plan and the investments that you're planning to make using transition finance, that you're going to shift to Paris-aligned technologies at a certain point in the future that is difficult to pinpoint right now. But to the extent that the government has shown commitment and provides this pathway, this increases credibility all around and creates probably a virtuous cycle, where by putting this pathway down and providing as many details on what corporates can count on in the future, it in turn, I would think, provides pressure on the government to actually follow through and meet those aspirations. In a nutshell, I think that this is the kind of dynamic that could be very helpful for the transition finance space, for transition plans. And maybe going back to something I didn't quite have time to speak about in my previous comments, mechanisms to prevent carbon lock-in. So just some of the ones that can be used are, for example, actions to future-proof transition investments. So they comply with relevant technical specifications for assets aiming to become low emission in the future. For example, on green hydrogen readiness, setting sunset clauses for phasing out fossil fuel use when a fuel switch is planned in the future, and then a date and a plan for early retirement of high emitting assets that can't be retrofitted. So in your plan, ideally, you would indicate when you're aiming to make this transition, and then coming back to these sectoral pathways and technology roadmaps. The goal in an imperfect world here with uncertainty is to create the conditions, and by stating it, and then sort of visualizing something, and then actually, hopefully, this will happen. I think that this process is a model for other countries. Every country will need to have its own approach. There's many challenges too in terms of capacity that we should acknowledge here. And I think that there will probably still be a fair amount of uncertainty in the space that we need to acknowledge going forward. And maybe two last challenges to point out here. Emission pathways generally have been developed at a macro level, so global or regional, and accounting for country-specific considerations is still challenging. And then also assessing the consistency of country-level pathways with the Paris Agreement, that can prove challenging too, due to complexities in determining global temperature outcomes for country-level pathways. And then there's also global and regional supply chains. So for each company, obviously these supply chains are critical, and how do you consider that? But bringing it back to the original question, I would say that developing sectoral emission pathways, they're a necessary and urgent step along with the development of transition plans, and as credible as they can be, in order to support credible transition finance.
Robert, I'm going to stay with you just for a minute and go off script, because I'm keeping an eye on questions, and I think there's one question that's come up which is very I think follows from what you just said. You know, one of the questions is well, I'm paraphrasing, of course. You know, I'm a corporate entity which is primarily in coal, and you know, obviously, my transition is going to be difficult. How can I use transition finance? And in the question, they're saying, well, should I, for example, switch to other assets, you know, such as critical minerals, you know, for the transition? And I think this raises a wider question of, well, you know, if you are a company in that sector, what's the future? And I know it's a tough one, Robert, but interested in your views.
Sure, I'll give that a shot. And I guess the first shot is a caveat that I think that the EU taxonomy, they didn't jump to develop what at the time was thought of as a brown taxonomy, gray taxonomy, what have you. And so this is a major issue that is currently being looked at in the context of financing early retirement of coal. And Alice mentioned that earlier. And I know that there's an interest at international level of developing potential gold standard in this space. I understand that there's methodologies, offset methodologies that are being proposed for early retirement of coal and getting, quote, credit for avoided emissions, and the revenue from those offset credits can be used to support the development of renewable energy. very complex new area, overall extremely encouraging, because there's a need to find practical ways to support early retirement, but not a simple question indeed, Nicholas. So maybe I'll stop there and see if others can help.
Yeah, I've got a follow-on question for Sean, but if anybody wants to jump in on this one specifically, please do so. Again, we're going slightly off script, but I think it's important. We've got sort of 19 questions, so I just want to start tying those in.
I would just add, I mean, I completely agree with Robert that one of the key transition strategies that we need to address is around accelerated coal phase out. And that's because many coal plants, in Asia Pacific are protected by long-term contracts, which were necessary to get the financing in the first place at a reasonable cost. But if they run to their expected life, that's 2/3 of the global carbon budget. And so it's not easy to work on this topic, but we're not in a position where we can shy away from dealing with difficult transition finance issues. And I would say this is one where I'm encouraged that there's renewed momentum this year in looking at this issue, and then maybe we'll come back and talk about some of the hard to abate sectors. But again, I think we need to get away from this this kind of worry that we can only talk about green, and if we start talking about hard to abate sectors, we're sort of moving away from thinking about transition. We know we need steel, we know we need cement, so let's try and find some solutions that work for these sectors and get them on the right pathways. It's really important for economic activity, for growth, for opportunity. Thanks.
Alice, thank you very much. Kobayashi-san, do you want to say anything from Japan's perspective on phasing out coal?
Well, thank you very much for the phasing out of coal phasing out of coal is sometimes not so easy. If there are alternatives, of course, no one wants to use coal. But for those who are using coal as a last resort, it's actually not so easy to get out from coal. And the one of the important points for us to design the or process to getting out from coal is that the for those who are using coal as a last resort, they are actually obtaining electricity from coal. So how to shrink the operation while keeping the healthy operation of the CFP is something very, very spiritually difficult, because you have to do the kind of contradictory thing. But it's important to manage this process to make sure that the Asian countries can reduce their reliance on coal. I just would like to.
No, thank you. And I know that was a tough one, so thank you very much for answering that. Sean,
well, not over yet. Not over
Sean, you go. I've got another question for you, but definitely comment on that. And then I'll keep on going with you.
Look, it's tough. It's tough. Yeah. But, as Robert said earlier, the IEA net zero strategy is very clear. We are stuffed if we don't close coal in a rapid kind of frame out. So we have to use that as a basis. And then, as Alice kind of says, whatever it takes to be able to do it is the essence of this. But we don't have clear solutions. I mean, we've got these JET-P programs everywhere, but we've got a challenge, we've got a resistance in some countries from, let's call it avoiding whack-a-mole. That is, you close down one coal post and it pops up over here. Indonesia is building new coal, still finishing off new coal-fired power stations while it tries to close a couple. This is a problem in terms of, we publish coal decommissioning guidelines, which, by the way, GFANZ have agreed to as well, and the Singapore taxonomy has agreed to, which tries to bring in a range of factors involved in assessing coal decommissioning going forward. There is clearly work to be done there, and we are going to, well, let's just say we as the rich parts of the world are absolutely going to have to be involved in shutting down fossil fuel assets around the world prematurely their life. No doubt whatsoever. The only question is whether it's going to take us 15 years or 5 years to sort this damn thing out. In Japan, as a particular problem, they've already created a bad bank, which is JERA, which is the Tokyo coal company. METI and others pushed all the electricity utilities to put their coal plants into a single entity in Tokyo some years ago now, which was a great move. And now the question is, what do we do with JERA? And this is one of the things that the government's wrestling with there. And, it's not clear at the moment. There's been talk of, can we replace coal with ammonia? There's research and development, but it's not at all clear that's possible. Hey, but it might be. Let's see what R&D takes us. It may be, if we can get enough clean energy pathways for Japan. That's still an open question, because there's discussions in the DIA at the moment about how to challenge some of the issues that you fixed in offshore wind, etc. Then we can, but it's a problem. All I'm going to say is there is no doubt, absolutely no doubt, in every single country in the world what our pathway needs to be. That's very clear. That's been drawn out. That's the IPC. That's the IEA. Our challenge now is to be creative in solutions to make the transition while keeping the lights on, because industry's got to keep working, the economy's got to keep coming, and nowadays managing energy security issues. It's hard. It's a wicked problem. There are no simple solutions, but watch this space, because there's some really incredibly innovative thinking going on around the world in different parties, in GFANZ, in Japan, in the US, in Europe at the moment. And I think we will make progress, and then we'll move on quickly to oil and gas, because exactly the same problem applies there. We have to make sure gas gets shut down by 2040, according to the IEA, and are absolutely resolutely focused on how we're going to achieve that as the second half of this story. So no simple solutions on the table just yet. We're just all wrestling with it. But sorry, Nicholas, you wanted to ask me another question.
No, thank you very much. And again, so no easy retirement for any of us, right? On these topics. But Sean, on something that's come up in several of the questions is something which we've talked about many times, which is coming back to the labeling of bonds. Japan has issued its bond under climate transition bond label, which is something which is in the updated CTFH handbook, the Climate Transition Finance handbook of ICMA. You have provided CBI, as you were saying, the certification. The question is, how important is this? I'll comment afterwards. ICMA has a view, but I want to ask your view. How important is this labeling between green transition or transition themes?
In one way, it's not important at all. That's why it's climate bond certification, come what may. We just need everything to be focused on 1.5 degree and the transition associated. But our understanding of what needs to be done to address the climate challenges, well, it's evolving quickly, right? 12 years ago, I can remember a conversation with an investor who said, trains, they're really dirty, aren't they? Why are they relevant? Hey, modal shift, low carbon transport, etc. And now we have, by the way, a very large slice of the thematic bond market going to railways. Equally, the addressing of the hard-to-abate sectors that Alice has mentioned is so important, is part of the increasing understanding that, we're not going to do this transition without steel and aluminium and chemicals and cement. So we've got to figure out how to tackle that going forward. And that's the expansion of the understanding. It goes further. We published last year, for UN Disaster Risk and Reduction, a framework for climate resilience, which is not just physical adaptation, it's social resilience, economic resilience. As we understand the nature of the challenge ahead of us better, and resilience becomes important because, hey, 1.5, we lost that battle, we're now onto a different battle, then we also understand more broadly the kinds of investments that are required to address that challenge. Our view keeps expanding. Now, there's a benefit. It's a marketing benefit. The label green is a marketing term, right? There's benefit in drawing attention to this. Transition is really useful, especially for emerging markets and countries with a strong industrial base, to draw attention to the fact that they are figuring out how to become greener. It's not about being green. It's about becoming greener over the next 5, 10, 15 years. And that's why the Japanese bond is so interesting, because of drawing attention. At the end of the day, for a green bond portfolio manager, it's a green bond. It's a use of proceeds green bond. We were going to argue it fits into a green bonds portfolio because it's about addressing 1.5. But it's a particular narrative about green bond, which is how to shift the whole economy, which is going to become the dominant narrative in the next few years, by the way. And of course, that's why Kate's work on transition plans is so important. That's why the US focus now on transition is so important, we will see this becoming a, an overarching thing. SLBs, one of the things you want to talk about, are just a way of drawing attention to transition at the end of the day. So I see the Japanese bond as important because it's the first time a government has resolutely said, we want to work on transitioning our economy in rapid time. The targets are very strong in Japan, in line of 1.5, but we know it's hard and we're starting here and we're investing in R&D towards doing it. So it's just a particular narrative, but it's a really important narrative to get on the table. And it opens doors for emerging markets who feel green. That's the Europe trying to tell us what to do. But transition, yeah, we understand we've got to change. And that is an important political economy narrative, as well as a marketing narrative to get investors to engage with. I mean, it raises some difficult things, by the way. We are encouraging investors to engage and invest in high carbon industries, which are going to throw out the decarbonization trajectories because they need to make them green quickly. So there's a whole lot of different ways of thinking as you start having a transition mindset that are important to understand what to do to create that future for our children that we're trying to create.
Thank you, John. And with the permission of the panelists, I'll quickly comment on from ICMA's point of view, because it's something which we've talked about a lot. And I think the first takeaway is, I think making the link also with Japan, we've always said that transition has to be addressed at the organization level, first and foremost, by disclosures and a strategy. That's what the CTFH is saying. And that's why the development around transition plans is so important, because it's sort of the further practical expression of that position. You really have to look at transition first and foremost at the organization. Now, then you can use various instruments to finance it. And in some cases, it's important what you call it, because some investors can invest in one type of label bonds and it's more difficult for them to invest in others. So it's a very practical market question. Some investors can invest only in green bonds, and it's more difficult for them to invest in something that's called a different name, or to invest in SLBs. But from our position, transition is a theme. So you have a green bond, it can have a transition theme. You can have a SLB, which is different type of product, measures KPIs and targets at the organization level. Again, very suited for transition, and there's some investors who very much prefer that position. And at the same time, in our update of 2023, we recognize that, again, with a nod to what's happening in Japan, saying, well, of course, you can have a climate transition label, and that we're seeing that particularly develop in some regions, and we don't see any contradiction in these approaches. More sort of different ways of again financing this theme. I'll stop there because I don't want to take over with on this one. It would be remiss of us not to talk about the US, and this is coming up in some of our questions, and I'm going to start with you, Alice, because there's a particular question around pushback in the US, particular with respect to transition, but with ESG more generally. GFANZ has in the previous year been in the news around dealing with that. I just don't know. I know it's a tough question, Alice, but I just want to know if you would care to comment on where we are with respect to that pushback and how that's impacting your work on transition.
Thanks very much. And just to be clear, with GFANZ, we're very much focused on transition. And so what we're actually seeing is a growing number of firms still making individual commitments to net zero, which I find quite encouraging. I mean, we started off in 2021 with 160 firms making such a commitment, and we're now, well north of 675, and that's continued to grow strongly in recent years. We started off with very high interest in net zero in advanced economy financial systems, including the US, Europe, Japan, UK. And what we've seen, I think, is a bit of a further deepening there, but also just a broadening as emerging market financial institutions also start on this journey. And I think it's encouraging that firms are still making these commitments, because it's actually really difficult as a financial institution to support transition. You can't deliver it just through your own actions. You're essentially saying that you're going to work to support the transition of the real economy. And why are big firms doing this? I think they're engaged because they see the opportunity, which has been mentioned by Sean, in supporting transition that can bring growth, bring new technology, bring competitiveness, new jobs, and so on and so forth. And we've seen in the US quite an encouraging dynamic of creating incentives for the corporate sector to make the investments needed, and then obviously finances flowing, including from outside of the US into the US to support these new investments. And so I think that's been quite a positive dynamic for the US. Obviously, we need to make sure that transition is a broadly shared goal, and that everyone has a chance to make progress on it. So in some ways, that's all good progress. I think we do know that a key aspect here, as whether countries do well on transition or not, is going to be around economy-wide planning by governments, and so and consistent planning through time. And so I think what we're going to see through time is that if countries can maintain a political consensus around transition and the benefits that it brings, and that they can undertake planning and keep that moving over the course of a number of years, they're going to really benefit from the investment and the transition finance. And so the US has obviously got off to a good start on that front, and we'll have to see what happens next. But yeah, I think where you're able to do that kind of government-led planning, that's a huge boost in your net zero journey. Thanks.
Thank you, Alice. We're also getting, and I don't know if everybody else wants to comment on the US, but we're also getting questions about the specificity of addressing transition in emerging markets, and we may have indirectly touched a bit on that, but I don't know if either rebound on the US or specific comment on emerging markets. We've got 3 minutes left, so we'll have to be quick, but please.
I mean, super quickly, everyone's going to need to transition. I think there is a risk that advanced economies have sort of gotten a head start on this, and that emerging markets get left behind. And so that's why in our own work, including through the JETPs, but also in other cross-cutting work we do, we're working really hard to try and support country-led efforts to develop transition plans. So the Just Energy Transition Partnerships are about countries like South Africa, Indonesia, Vietnam, developing their own energy transition plan. And as was mentioned before, it's really difficult to transition your energy system, deliver reliable, cheap energy whilst also hitting your climate goals. And so we're trying to make sure that private finance plays its part in those initiatives. And I think one critical thing here is the quicker we can develop common global baselines for key transition finance definitions, for transition planning, and some of the architecture that's needed to unlock finance, the less likely it is that we see a continuation of the current trend, which is that very little transition finance is flowing to emerging markets already. So if you look at energy transition, they're getting, excluding China, something like less than 10% of energy transition finance is going into emerging markets, and we have to do something about that. Otherwise, they will be left behind. But we're, at least for our part, we're working very actively on that. Thanks.
Other comments on emerging markets or the US? We've got 2 minutes to go, so I'm turning to the panel if somebody wants to jump in. Kate, please.
Yeah, or just to add that one of the issues raised by stakeholders around the TPT's work has been around the intersection of transition plans and emerging markets, developing economies. So we have done a little work on that. We hope to publish a paper along with our deep dive guidance, and we've been working closely on that with GFANZ, and given all the work they've done in this area, I think fundamentally there is a challenge and an opportunity to sort of the multilateral community that is putting all these definitions and rules together and so forth, to use the opportunity that transition planning creates and potentially use that as a tool to mobilize finance and investment. Sometimes I think there is a risk and a fear that either due to lack of data or due to the risks that might be disclosed, actually that things might go the other way. and that this might just become a cost, a burden, and a disincentive to investment. But there's a very real opportunity to get it right and make things flow the other way. And I think that's important for, you know, sort of governments, regulators, multilateral groupings to have in mind as they are setting out definitions of transition finance, setting out principles for transition planning, etc. That is part of the goal.
Thank you. We may need to stop with that, where we're exactly at the time that we had planned. It's unfortunate we have lots of other questions. I've tried to tie them. I apologize to those of you who we haven't been able to answer. I encourage you to reach out to us, either at the ICMA or individually to some of the panelists with your questions. Transition is just such a vast and important topic. I want to thank my panelists. I thought it was a really good debate. We managed to get into substance. We kept to time. We got a variety of views. So thank you again. And with that, I'm gonna close this ICMA webinar. Watch this space. There'll be more from us and collectively. Thank you.